You ever get that feeling that you're living in a totally different economic reality than the one you see on the news? That maybe you missed the memo about how great everything is? Well, I'm here to tell you, you are not going crazy. And in this explainer, we're going to break down exactly why the economy feels so weird right now.
I mean, you hear it all the time, right? GDP is growing, unemployment is super low, big companies are posting these record profits. The headlines are basically screaming that everything is booming. So why do so many of us feel like we're just treading water, or even worse, like we're slowly sinking? Well, that's the big paradox we're going to unpack today.
Okay, so here is where that disconnect becomes crystal clear. On one hand, you've got the stock market hitting all-time highs, a classic sign of a strong economy. But on the other hand, you have how people actually feel. A key measure for that, the Consumer Confidence Index, just plunged to 84.5. And to put that in perspective, that is its lowest point since May of 2014. These two things they don't seem to exist in the same universe.
So what is going on here? How can these two conflicting stories both be true at the same time? Well, the answer isn't some super complex economic formula. It's actually hidden inside a single letter of the alphabet.
It's the buzzword on Wall Street.
On the K-shaped economy.
Something that economists called a K-shaped economy.
This economics report was brought to you by the letter K.
And that letter is K. We're talking about the K-shaped economy. Now, this term really took off during the pandemic because it just perfectly captured this new reality. After a big economic shock, instead of everyone bouncing back together, the economy literally splits in two. One group shoots straight up, doing better than ever, and at the exact same time, another group trends down, really struggling. You put those two lines together, and you get the shape of the letter K.
So the really important question is, who's on the top path and who's stuck on the bottom one? Let's break down exactly who makes up these two arms of our new economy.
And the divide is pretty stark. That upper arm, the one going up, that's high-income earners and, this is the key, asset owners, people who own stocks, real estate. Their industries, tech, AI, are absolutely booming. Then you look at the lower arm, the one going down. That's home to low and middle-income workers, especially younger generations, who are way more likely to be renters with their money in cash savings. Their jobs are in sectors like hospitality and retail. At its core, the split is between owning capital and earning a wage.
Now, this massive split didn't just happen by accident. There are some really powerful economic forces at work, kind of like an engine that's actively pulling the two arms of this K further and further apart. Let's dig into the two biggest ones.
Force number one is something we have all been feeling in our wallets: inflation. Economists sometimes call it a regressive tax because it's the opposite of an income tax. It doesn't hit the rich harder, it absolutely hammers lower income people. It disproportionately punishes everyone on that lower arm of the K.
And this chart shows you exactly why. For lower-income families, a giant chunk of their money goes to absolute necessities. We're talking rent, food, gas, the stuff you have to buy. You can't just cut back. So when the prices for those things explode, there's no buffer, there's no cushion. It's an immediate, full-blown crisis.
But for higher-income households, it's a completely different world. Look at that. Necessities are just a much smaller piece of the pie. They have this huge cushion of discretionary spending and investments. So yeah, inflation is annoying for them, for sure. But it doesn't threaten their basic financial stability. It doesn't shake their foundation.
All right, force number two is a huge structural shift in the corporate world. We can call it the efficiency play. And it's all about this idea that a company's success is no longer tied to how many people it employs. They've been decoupled.
As artificial intelligence continues to progress, could we soon see some entry-level jobs disappear? In recent weeks, a few of Silicon Valley's top leaders have warned that AI is coming for people's jobs, and fast.
This has become the new corporate playbook, and it's almost like a four-step formula. Step 1, a company uses AI to automate jobs and get more efficient. Step 2, it announces major layoffs to slash its labor costs. Step 3, Wall Street absolutely loves this. They call it fiscal discipline, and the stock price jumps. And Step 4, who gets rich? The shareholders, the very same people on the upper arm of the K.
And look, this isn't just the theory. The data is shockingly clear. On average, big U.S. tech firms have seen their stock price climb 5.6% in the single month right after they announce big job cuts. The market is actively and immediately rewarding this exact behavior.
And we see this pattern play out over and over. Let's take Meta. During what they called their year of efficiency, they announced massive layoffs. And the result?
the stock surged an incredible 19%.
Or look at Spotify. The company announced layoffs, and its shares jumped 7.5% just in the following week. Investors loved the move, calling it a commitment to bigger profits.
Even Amazon, same story. In February 2023, right after announcing they'd cut about 16,000 jobs, the stock immediately popped 2.1%. The message from the market couldn't be clearer. Cutting human workers is great for your stock price. So we've looked at the big economic engines pulling this K apart. But let's get real for a minute. What does this actually feel like for the millions of people who are just trying to live day to day on that bottom arm? This is where the numbers stop being abstract and start being about the psychology of survival.
It's a feeling that millions of people will instantly recognize. It's living by the one emergency rule. It's that constant, low-level anxiety in the back of your head, knowing that you are just one car breakdown, one surprise medical bill away from complete financial disaster. You're not planning for the future. You are just trying to survive right now.
Inflation has been moderating in recent months, but prices are still nearly 24% higher than at the start of the pandemic.
I am a teacher in St. Louis County, Minnesota. Since the price of eggs and bacon has gone up, we've done a lot more cereal. Eat it with your spoon. You gotta stay safe in the car, right? I've had to take on a second job just because everything has gotten so expensive.
I'm a police officer in Waterbury, Connecticut. I'm 29 years old. I've been a police officer about a year. Let's go. But every day is a struggle for me too. If I still have to worry about my next paycheck, where my next meal is coming from, I'm just like anybody else out there.
The skyrocketing cost of living has left millions of people working at full-time jobs or a number of part-time jobs still unable to afford a place to live.
And it's not just one thing, right? It's this toxic cocktail of chronic stress. Sociologists even have a term for it, permacrisis. You've got the financial suffocation from inflation. You've got the new fear that your job might be made obsolete by AI. You see chaos happening around the world, and you feel it directly every time you fill your gas tank. And all of it is wrapped in this deep, nagging feeling that the whole system is just rigged. It's not just tiring. It's completely demoralizing.
A World Economic Forum survey published earlier this year found that roughly 40% of companies from around the world expect to reduce their workforce in roles where AI can do the job. I mean, the natural response from so many people is, oh no, AI is coming for my job. Is that the fear? Is that the truth?
It's definitely a legitimate anxiety. We actually believe that 85% of professionals are going to be affected by AI.
And this right here is the emotional core of the whole thing. When the official data says the economy is strong because the stock market is up, but your bank account is empty after paying for rent and groceries, it creates this profound sense of being gaslit by the very system you live in. And that feeling just erodes trust in everything. So this all leads us to the central conflict of our time. We're not living in just one economy anymore. We're living in a tale of two totally different realities, the reality of Wall Street and the reality of Main Street. And if you take just one single thing away from this whole explainer, please let it be this. The economy is not the stock market. Let me say that again. The economy is not the stock market. The stock market reflects the health of the upper arm of the K, the asset owners, the investors. Main Street reflects the health of the lower arm, the wage earners, the renters. And as long as we keep confusing the two, we will never understand what is really happening. And all of this leaves us with a fundamental and maybe pretty uncomfortable question we all have to face. In an economy that is structurally shifting to reward owning things far more than it rewards doing things, how does a person get ahead?